Plug Power is currently trading at $3.51, down 7.14% for the day. While many investors are fixated on that sharp intraday drop, what they're likely missing is the subtle but significant shift in institutional sentiment happening behind the scenes. The narrative you hear everywhere is that PLUG is the future of green energy, a pure-play bet on the hydrogen economy. The expectation is a straightforward story of growth, government subsidies, and a clean energy transition. The reality, however, is a far more complex picture of immense cash burn, diluted financing, and a race against time to achieve profitability before the market's patience wears thin. It's a classic battle between a grand vision and the brutal, day-to-day realities of building a capital-intensive business from the ground up. Investors trading on platforms like Robinhood or SoFi Invest often get caught up in the high-level story, but the real story is in the numbers and the operational execution, which has been inconsistent at best. The common belief is that with legislation like the Inflation Reduction Act providing substantial tax credits for green hydrogen production, Plug Power's path is all but guaranteed. Investors see the company's major partnerships with giants like Amazon and Walmart as proof of concept and a clear runway for expansion. This creates an expectation of exponential revenue growth, where the company scales its hydrogen production facilities and its fuel cell deployments, eventually turning into a profit-generating machine much like early investors hoped for with names like Tesla stock. But this outlook often glosses over the harsh reality of the company's financial state. For years, Plug Power has been a story of promise, but not of profit. The company's negative gross margins have been a persistent red flag. It's one thing to sell a product. It's another to sell it for less than it costs to make. While management assures investors that this is a temporary issue related to scaling and the price of natural gas, a key feedstock for its current hydrogen production, the market is showing signs of fatigue. Many are starting to wonder if the path to positive margins is a distant dream rather than an achievable short-term goal. This is the kind of deep financial analysis that investors using sophisticated platforms like interactive brokers focus on, looking beyond the headlines to the core financial health of the business. Let's dissect the recent stock movement to see this tension play out in real time. Today's 7% drop isn't happening in a vacuum. It's part of a brutal, prolonged downtrend that has seen the stock fall from its lofty highs. The 52-week high is $4.58, and the low is a staggering 69 cents, which tells you everything you need to know about its volatility. This isn't a stable blue chip like Apple stock. It's a high-beta, speculative play. Trading volume today is fairly typical, suggesting this isn't a panic-driven sell-off, but rather a continuation of the prevailing bearish sentiment. What's concerning is the pattern of rallies being sold into. Every piece of positive news, a new partnership, a plant reaching a milestone, is met with a temporary spike, followed by a steady bleed-out as long-term holders and institutions likely trim their positions. Why? Because the smart capital understands the immense financial pressure the company is under. Plug Power's cash on hand is being depleted at an alarming rate. Its latest earnings report highlighted a significant cash burn, forcing the company to rely on capital markets to fund its operations and expansion plans. This often means issuing more shares, which dilutes the value for existing shareholders. It's a vicious cycle. The stock price falls, making it more expensive, in terms of dilution, to raise the necessary capital. It's the kind of complex situation where some investors might turn to services like Schwab Intelligent Portfolios or Fidelity Wealth Management to navigate the risks, while self-directed investors on Fidelity or SoFi have to weigh the high potential reward against a very real risk of further downside. For those less familiar with the company, Plug Power operates in the hydrogen fuel cell space. Its primary business involves designing, developing, and manufacturing hydrogen fuel cell systems that replace conventional batteries in electric equipment and vehicles. Its flagship product, the GenDrive system, is widely used in forklift trucks in warehouses and distribution centers for customers like Amazon, Walmart, and Home Depot. This is the company's bread and butter segment, but the bigger, more ambitious part of its strategy is to become a vertically integrated green hydrogen giant. This means not just providing the fuel cells, but also producing and supplying the green hydrogen itself. They are building out a network of hydrogen production plants across the country, aiming to be a key supplier in the nascent green hydrogen ecosystem. This vertical integration is where the massive growth story comes from, but it's also the source of the immense capital expenditure and operational challenges. Building electrolyzers and hydrogen liquefaction plants is incredibly expensive and complex. The expectation is that once these plants are online and producing at scale, costs will come down, margins will turn positive, and the company will control a significant portion of the hydrogen supply chain. The reality has been a series of delays, cost overruns, and operational hiccups that have shaken investor confidence. A key plant in Georgia, for instance, faced significant startup challenges, impacting the company's ability to meet its production targets and financial forecasts. Looking at the broader market context, the renewable energy sector has been under pressure. Higher interest rates make it more difficult for capital-intensive companies like Plug Power to finance their growth projects. When the cost of borrowing goes up, the projected future earnings of growth companies are discounted more heavily, making their stocks less attractive. While a name like NVIDIA stock has been able to power through this environment due to its dominance in AI, speculative growth companies without a clear path to profitability have been punished severely. Plug Power is caught right in the middle of this macroeconomic storm. Furthermore, competition is heating up. While PLUG has a first-mover advantage in the materials handling market, other larger, better capitalized industrial gas and energy companies are also entering the green hydrogen space. They have the existing infrastructure, deep pockets, and operational expertise to become formidable competitors. The expectation is that Plug Power's technology and market position will keep it ahead. The reality is that it's in a race against giants, and its financial constraints are a significant handicap. This is a crucial point for anyone considering an online investment in the hydrogen sector. You have to analyze not just the company, but the entire competitive landscape. Do you believe PLUG's technology offers a durable competitive advantage, or will it be commoditized over time? Comment below with your thoughts on whether you think green hydrogen will be a winner-take-all market or one with multiple successful players. So what does the future hold? There are a few potential scenarios, each hinging on the company's ability to execute. The bullish case, the one that keeps long-term believers holding on through the pain, is that the company successfully navigates its operational ramp-up. In this scenario, its hydrogen plants come online smoothly, production costs fall as guided, and the company starts generating positive gross margins within the next year or two. If the IRA tax credits are fully realized and the demand for green hydrogen accelerates for transportation and industrial applications, Plug Power's stock could see a dramatic recovery. The company would finally grow into its valuation, and the years of burning cash would be justified as necessary investment for market leadership. This is the reality that many who use investing sites and apps are hoping for. They see the long-term potential and are willing to stomach the short-term volatility. The bearish case, however, is equally plausible and represents the stark reality of the company's current situation. In this scenario, the operational issues persist. The cost of producing hydrogen remains stubbornly high, and the company fails to achieve positive margins. The cash burn continues unabated, forcing more and more dilutive share offerings. At some point, the market may lose faith entirely, leading to a liquidity crisis where the company struggles to raise the capital needed to survive. In this outcome, shareholder value is severely eroded, and the stock could languish at these low levels or fall even further. Competition from larger players could squeeze Plug Power out of key markets, relegating it to a niche player rather than the market leader it aspires to be. This is the crucial point for anyone considering an online investment in the hydrogen sector. You have to analyze not just the company, but the entire competitive landscape. Do you believe PLUG's technology offers a durable competitive advantage, or will it be commoditized over time? Ultimately, investing in Plug Power today is a bet on execution. The vision is clear, the addressable market is potentially enormous, and the political tailwinds are supportive. The expectation is set for a massive success story. But the reality is that the company is walking a financial tightrope. Management has to prove it can translate ambitious plans into profitable operations. The next few quarters will be critical. Investors will be scrutinizing every earnings report for progress on gross margins, updates on their hydrogen plant operations, and a clear handle on cash burn. The gap between the story and the financial results needs to close, and it needs to close soon. The expectation of a green energy titan has been the narrative for years. Now the market is demanding the reality of a financially sustainable business. Without it, the stock will continue to struggle regardless of the long-term promise of the hydrogen economy.